All right. So, hello everyone. Firstly, thank you so much for joining in. My name is Vikas Agrawal. I am the founder of AIF and PMS Experts India. It's a digital platform where you get an access to all the portfolio managers. And today it's a very special day because we've invited Mr. Abhay Agarwal. Well, he doesn't need any sort of introduction. I see him doing a lot of investor education program all over India. Abhay brings about more than 2 decades of experience in terms of equity investing, in terms of investing in non-listed space as well. He himself is an angel investor and has invested and sat on the board of many organizations, large organizations, which has become very large and become, some of them have become unicorn as well, or close to becoming unicorn in terms of their total size. So, I thought I'll invite him and request him to spare some time on investment philosophy which he follows at Piper Serica. So he's the founder and the fund manager over there, manages both PMS as well as AIF, and they've also launched one of the AIF. So we wanted to know more about that as well. Of course, we're not going to discuss too much about the product, because as a category we're going to talk about how does it work. So we'll try and read his mind and understand how the structure works, and then probably get into any question and answer you may have. So I'm not taking too much of time. Thank you so much for taking the time out from your busy schedule and joining in today, Abhayji.
Yeah, sure. Thank you, Vikas, for that kind introduction, and thanks to you and to the team at AIF and PMS.com to invite me, give me an opportunity to talk to your investors. As you said, I always enjoy engaging with investors, benefiting from their experience, their learnings. Also, it's always a two-way process. So Vikas, would you like me to start with our AIF Angel Fund, or should we? So okay, great.
Yeah. So the format of the show is basically a Ask the Expert show. Yeah. We invite experts like you. Sure. We try and read your mind, understand what's your views on the markets, and because you bring so much of experience on the table, you've invested in other emerging markets as well during your stint with JP Morgan. So we just want to begin my first question with what's your views on the markets, and then we'll dwell upon other aspects.
Yeah. So I think I've been investing for 28 years now. I've seen different market cycles. I remember my first job with Citibank in 93. I was 23 years of age. I was given the opportunity to manage a fund. And I remember that time the markets were very shallow in terms of, their developmental stage, and there was no digitization. I remember the Nifty index was launched in 1995, and it was at about 800 levels that time. And I remember my country head used to always worry that 800 may become 750, and then there would be MTM loss. So my point of giving that story is that at 800 levels we were worried, and then there is constantly a worry with investors. But if you see what has happened in between, you ignore that there are multiple wars, government changes, depressions, crisis, everything has happened. But from 800 levels in 96, we are at almost 17,000 levels now. So frankly, my experience, Vikas, has been that, investors should not sweat the small stuff, not worry about what is happening in the market right now or yesterday or today. Today's Fed and tomorrow will be something else and day after will be something else. There are always reasons to worry. But I think the best way to override that short-term market volatility is to come up with a good investment strategy, a good asset allocation plan, work with experts like yourselves, and stick to that plan. Do not tweak that plan, because markets will go through their cycles, and it is very difficult to predict market cycles. It's very difficult to say when exactly will the markets turn around, what is the point at which bottom will be formed or top will be formed. I think these things are known only in hindsight. And right now, as I look at it, I think what has happened is since January, there have been multiple dips that people have tried to buy into with speculative intent, expecting a recovery, and those recoveries haven't happened. So every month the market has been dipping. We saw that in April, May, June, July, and FPIs have been sellers, and investors have been taking money off the table. And then there came a time last month where even the diehard fans stopped buying. They said, look, enough is enough. How much dips are we going to buy? So maybe better to sit in cash and ride out this volatility, ride out this uncertain period of war, interest rate hikes, commodity price inflation. God knows what is going to happen. So just sit out. And a lot of people, just sat on cash. And that is the point at which, typically I've seen markets form a bottom, at the point of peak pessimism when nobody wants to buy. It is like the diehard guys also say that how much mark-to-market hit I'm going to take.
Yeah.
Let me just sit out. And I personally think that now the markets are discounting all the known risks, and they are, unless there is something which goes terribly wrong, which is unknown, I don't think the markets are going to go through another sharp correction. I mean, always there is a caveat that you may be surprised, but I think the markets have formed a good bottom. I also think that a lot of cash is sitting on the sidelines, which is willing to come in at the sign of slight good news also. So I think if I take all those things into account, and also take into account the result season that has unfolded, and I think the results have frankly been better than what expectation was. Like today, we have our portfolio companies like APL Apollo and Laurus Labs, Bajaj Finance announcing results, and they were all quite good. I would say overall, the results have been better than expectation. And I think once you get into that cycle that people start seeing hope, and earnings, at the end of the day, markets follow earnings. And if earnings stack up, and which we think they would, this year, next year, and year after that, then I think the markets are pretty well poised after the correction that we saw, 30 to 40% valuation correction that we have seen in some of the leading stocks also, IT, pharma space. I think it's a good opportunity, for investors to stick to their allocation plan, increase their allocation if they need to.
So we feel that results are good. Earnings season is really surprised us positively. So therefore, nothing to worry about. But of course, you really can't go and say that you can predict the markets. Nobody can do so. Yeah. But having said that, looking at the current scenario, it looks like that things might start settling down from this month onwards. Yes. So thank you so much for enlightening us with your thought process. So now coming to this PMS and AIF. So one is that you have your PMS book. On the other side, you are also building up the AIF. So can you talk to our investors about how it is placed and positioned within the organization? And then we'll come to third question of product.
So you're talking about the angel fund AIF that we have.
Yes.
So in terms of our public market investments that we do through PMS and through our FPI, which is based in Mauritius, it's a fund called Piper Serica Leader India Fund. And then we also host model portfolios on smallcase.com to give even smaller investors access to our strategies. So we have a very robust public market investment arm, and that has done well and is growing. And then what has happened is that I have personally been an angel investor for a long time, and that experience actually goes back to when I used to work for JP Morgan Private Equity Fund in 98 to 2004, where I gave seed capital to a lot of companies that have gone on to become very large companies, like Jubilant Foodworks was a startup in 2000, when we gave seed capital of $15 million. Then HDFC Securities is a company we gave seed capital to. Then there is MTR Foods that we gave seed capital to. So I have plenty of experience in that space, and then subsequently personally I've been investing and have done that pretty well. Now the whole startup space has got a lot of visibility over the last 2-3 years. You would have seen, because of news about so many companies becoming unicorns, foreign investors coming in and investing, and then a lot of our HNI investors want to allocate some of their equity capital to private market investing also, and that is a global trend. If you see globally in the US markets, the HNIs typically have an allocation to equity, partly 10, 12, 15% also to private investments, through angel funds or angel investing. And that is the need that we were asked constantly to meet by our investors, who said that, look, we want to invest in startups, but we really don't know how, because this is a very risky proposition. We don't know when we will get the money back. We don't know how we will get the money back. We don't know how to track our investment. It's a very different experience compared to a public market investing, where there is a lot of transparency, information. Investors can exit whenever they want. They can enter whenever they want. Startup investing is not like that. It's a very different thing, but it has its own unique upsides also, because the returns are higher than public market investing, because at a portfolio level you invest at much earlier stage. So the intention is to basically give our investors access to startup investing through this fund, and the fund strategy is to invest. It's a 100 crore fund which will invest in 30 odd companies, startups, and we will be a co-investor. So we would co-invest along with other strong lead investors. There are funds like Secovia, there are funds like Y Combinator, Let's Venture, Angel List, and there are a lot of syndicates. So our objective here is to first look for very good quality founders, support their business that we should like, and then once we like the business, we should also like the lead investor who's going to mentor these founders, and then to invest as a part of a syndicate. So our investment of the total round will not be more than 25 to 30% of that round, because we think that the probability of success is higher if more investors are involved, helping the founder, achieve their targets, achieve their dreams. So that is the objective, that this 100 crores we should be able to invest in 2 to 3 years time. And then what we target to do is to provide exit to exit the profitable ones whenever we get an opportunity, in a manner that we can return at least the capital back to our investors as soon as we can. And the rest of the fund then will continue, and over next 6, 7, 8 years should return, pretty lucrative returns to the investors. So that is what our plan is. We have set up a separate team for this AIF. My colleague Chirag is there on the call, Chirag Goradia. Then I have Abhay also, and then we have other people, Yash Pawar from my team. So we have already set up a team for this AIF, and we are quite excited because we think that angel fund startup investing in India is finally taken off. There's a great acceptance from the ecosystem. There is a lot of capital chasing the successful startups. A lot of employees or talent is willing to join startups. So I think there is a very positive ecosystem that is getting created and already got created. So I personally think for next 5 to 10 years, HNI investors would do very well to allocate part of their capital to startups also, especially those who can afford part of their funds to be illiquid for some time in lieu of higher returns.
Which I want to clarify here is that there has been some sort of miscommunication or perception. I would say that people feel that in category 1, the minimum threshold is 1 crore,
yes,
but here it is 25 lakhs. So can you throw some more lights on that?
Yeah. So you're absolutely right. It is a category 1 AIF. Now, typically a category 1 AIF has a minimum investment of 1 crore. However, since SEBI and government want to promote angel investing, startup investing, so they have done a special carve out for angel fund. So this is called a category 1 VCF -angel fund. So once you are in that category, the minimum investment is 25 lakhs, not 1 crore. And also there is a relaxation of the investor criteria, investor net worth and income, and all those criteria also get relaxed a lot. So the intention of SEBI is that these funds should be able to because these are illiquid funds, till there is an exit in the portfolio, the fund cannot return back to the investors. It should be attractive enough for even large investors making small allocation of 25 lakhs should also be able to participate.
Good also for mass affluent investors to they can sort of participate through and then participate, not only participate but also ride through the growth journey of these startup, as you rightly mentioned that I remember I was looking at some data points that during 80s, US used to be in where India is today in terms of encouraging startup companies to grow. And our honorable Prime Minister makes it the point always that, it's that our ecosystem should also become even more larger going ahead. So in a way, it is a good opportunity also. So just wanted to understand what would be the duration and, how long, what would be the drawdown sort of thing that you plan, if you can just talk.
Yeah, sure. So what our plan is that we will there is an investment period of 2 to 3 years, because if you're going to make 30 investment, it requires a lot of time. For making 30 investments, we have to review probably 300 to 500 companies, and once we like something, then it will take us time to also go through the process of diligence, process of documentation. So I would imagine that it would take us about 2 years to deploy this money. So that is why while the commitment from an investor on the contribution agreement is 25 lakhs or more, we are right now going to draw down only 40% of that amount, and that 40% of the amount will take us about a year to deploy, and then we will draw down the next 40%, and then the balance 20%. So I think it would be safe to assume that first drawdown, second drawdown, and third drawdown together will take place over 2.5 years. So it's not that the money has to be, entire amount has to be invested upfront. Upfront is only 40%. And then we want to stay invested in these companies that we have invested in for ideally as long as possible, because these companies go through a life cycle stage where first 3 years they are investing and then they start seeing benefits. It's only about 5 years when you really start assessing the success, you start seeing the scaling up, the critical mass starts coming up for a startup, and then the value realization, real value realization, takes place over 7-8 years. When either it is mostly through an acquisition, or it is by a large company buying out the small shareholders, or a large fund buying out small investors. So this is what the typical journey is. But I've seen that some startups scale up very fast. The promoters, founders get very good offers and gives an opportunity to early investors to also exit. So that is a possibility that we will definitely entertain. But going by my experience of looking at companies, like if you take an example of Nykaa or Policy Bazaar or Paytm or some of these other successful startups, they have taken about 12 years to go from seed stage to IPO. And I don't think in this fund we are really looking for a company, or we have the time that we will be able to hold to see a company go from seed stage to IPO. I think that would be low probability event. But we will definitely be in a situation that a pre-IPO exit can be made, by our investors. So once the companies are successful, we don't really want to exit too fast. We want to stay invested. We want the compounding to take place, so that we are not exiting at 10x returns when 100x or more is possible within 2 more years' time. So that is why we have kept the fund life of 10 years. But I would imagine that the average holding period, would be about 5 to 6 years for an investor.
Can I say that, once the drawdown is over, which takes about 2 to 3 years time, and then maybe, as you said, that the holding period is 5 years to 7 years, or sometimes 8 years, and assuming that you get exit after 5 years down the line, so initial 3 years plus 5, from 7th year onwards, one can start expecting some money back from the exits, or you want to keep it with yourself?
No. So first of all, the way the fund structure is, the SEBI regulations are very clear that whenever there is an exit, the money has to be returned to investors. So each investment that we make in a company is a separate scheme, as it is called. So it will be, once the investors get their annual statement, they will say scheme 1, scheme 2, scheme 3, scheme 4, which is each investment. And as those investments are exited, we have to return money back to the investors. We do not have the ability to keep it in the fund. And that is why our endeavor would always be that within 5 years of the first drawdown, 5 to 6 years, we should be able to ideally return the capital back to the investors, whatever we have drawn down from profitable exits, and then hold the remaining exits for as long as we can within the fund duration, so that we can optimize the returns after that even more.
Abhay, where do you think, so there are two questions. One is, so what sort of companies that you would be looking at? You've made up in your mind that, these IT startups, they grow exponentially, so you would be looking at that, or you are open for all sort of ideas. So maybe we'll start with that, then I'll ask you second question.
So let me first tell you that what we are not going to invest in, and then I will come to what we are looking to invest in. What we are not going to invest in are companies that have physical products, like beverage company, or a food company, or a clothing company, or a shoe company, or a perfume company. Not to, or a D2C company, not because we don't like that space, but just because that by nature that is a business. Even when it is successful, it requires constant infusion of capital. So these companies, they need to build warehouses, they need to stock inventory, they need to spend money on marketing, they need to constantly introduce new products, new launches. They need to build a team of feet on street salespeople. So what happens is that even when you grow, you need to constantly raise capital, and as a result, there is constant dilution. And it is not the optimal use of early stage investors' money. So where we see from our experience, interesting opportunities are companies that are using technology. Now, technology can be a software, it can be a tool, it can be a new framework, a new methodology, a new way of doing something to basically make an existing process more efficient, or disintermediate supply chains or distribution chains wherever there is fat distribution or supply chains in any industry, or just do something better, faster, and cheaper using a core IP, intellectual property, that has been developed by the founders. Because we have seen that these businesses, when they are successful, especially in the B2B space, they scale up very fast without requiring incremental capital. And as a result of that, the returns for early stage investors are very high, are significantly better than a physical product company. So now what we want to invest in companies like these, and then we do not really care about whether these companies are in which industry. So for instance, we have invested in companies that are in space technology, or in logistics management, or in healthcare. There's a company that is doing cancer detection through blood markers. We have invested in companies that are in fintech space, doing BNPL lending in a very intelligent way. We have invested in companies that are developing vaccines, in a more intelligent way, or companies that are in education, tech space, online gaming space. So across the space, we have invested in companies that are using core tech to make a differentiation. So that is the focus, to identify founders that are themselves tech experts, and to back them in disrupting something, or so the closest proxy would be as commonly called B2B SaaS or B2C SaaS companies.
So Abhay, what are your key learnings after investing in some of the unique businesses like Khatabook or Creditas, Fleetex, and Junio, Pink Blue, and Wipro? So these are the businesses that you've already invested, Minovex and InSource. So any key learnings that you want to share, and would that help you to kind of imbibe those learnings while you are investing for the investors?
I think that's a great question, because I think that's a fantastic question, and we discuss this often, that what is it that has worked for us over last 10, 15, 20 years, and then so we should stick to that rather than trying to do new stuff. So what is the biggest 2 or 3 learnings are, first of all, that founders make all the difference, and when you are coming in so early, there is frankly very little you have very few variables that give you direction or clear direction. There is a judgment call that you need to take based on your experience. And one of the biggest calls that you end up taking is on the founders. And then when you're assessing a founder, you have to, beyond just looking at, look how passionate this guy is, how well connected in the industry this person is. You also have to look at certain qualitative traits, that how how much of a fighter the founder is. Because in a startup, there are 99 bad days and one good day. And you have your own company, because I have my own company, so you know what I'm talking about. And I think a lot of our investors here on the discussion also know what I'm talking about. As a business person, you go through tough times, bad news, and it comes from all over the place. And these are young founders. So how do they react to that? Do they give up, run away, or they say, fine? My experience is that the good founders pivot. If one door is closed, they look for the new door to open. They are always, scrapping for business. They have no ego. They don't give up when somebody says no. They just find either somebody else who says yes, or that they figure out a way to convert the no into yes. So that whole ability to fight the system, to fight the no's, to fight the skepticism is very important, and to constantly pivot, constantly see opportunities, be very flexible, take inputs, learn from mentors, learn from others. That I think is probably, I would give it 80 out of 100 marks when you're assessing a startup. The second thing is capital allocation. Once the investors and frugality. So typically the good founders are very cognizant that they should not run out of money. And it's like oxygen for a business. So when a startup stage, we give them money as angel investors. Let's say we have given them 1 cylinder of oxygen. Now, typically the guys who are not very prudent would blow up that oxygen very fast. They would sprint. They would say, okay, let's buy a big office. Let's buy, hire too many people. Let's do very aggressive marketing. And then they run out of money and they panic and they say, where do I raise the next round from? And the high mortality rate and the biggest reason that startups die is because they are not able to raise the next round of funding, and all doors close. So typically the good startups I've seen are very cognizant that they should raise money well ahead of time. They should always be well funded, even though people are telling them that don't raise money now, raise money later, higher valuation. The clever founders always are well funded. And the third thing is that the ability of the founding team to attract talent from the industry, talent from because the good employees want to work for good founders. That is something that I've seen. These founders have to be charismatic enough that they should be able to draw the best people from the industry, the best coders, the best salespeople, the best ops people. They want to work with very good founders. So I think these 3 or 4 things are very important. From my experience, that every crisis is an opportunity. You should not give up, and that attitude is, when it is there, then I've seen I'll tell you very frankly, Jubilant FoodWorks, which is a company that has $4 billion of market cap, when we invested in 2000, within 1 year the company went bankrupt because they opened up too many stores all over the place. The stores didn't do well. There was low footfall, and then there was panic, and the money that we invested ran out, and the company was bankrupt. And then we had to get involved to turn around the company. We got a new CEO, gave a little more capital, and then from that situation, the company pivoted and is now where it is. You can see. So that attitude is very important. So it's a qualitative aspect, which I'm discussing since you asked me that question. Is what I'm saying is highly qualitative. It requires a lot of experience to judge it.
Yeah.
So I think that to me, these are the 3 or 4 things that are very important.
So Abhay, the other question is, we saw good amount of valuation improving, especially in last 3-4 years, particularly in startup space. And then last 3-4 months, we are talking about some in startups sort of asking people to leave and they are not able to raise funds, as you rightly said. So, what's your reading about as far as startup spaces in India is concerned?
Yeah, see, the startup space, the whole startup space has very low entry barrier. Frankly, what happens is that anybody can decide to become a startup founder very quickly. There is no entry barrier. There is nothing that stops you from launching a company or a partnership and launching a product or service. So when the entry barriers are so low, the industry, and on the other side you have limited capital, because the capital is not infinite. So in that situation, it is quite, not only in India but even in other countries, it is quite normal to see the startups, going through these cycles of availability of easy capital, lot of capital, to availability of limited capital because people have become cautious. And by nature, the industry has high mortality. We haven't, frankly, in India so far, we haven't seen that high mortality. I think that is the zone we are getting in now. Some of it is covered in media, some of it is not covered in media, because there are a lot of startups which are struggling to raise the next round of capital because even their existing investors are not willing to support them. The businesses haven't taken off or in a way that they should have, or there are other issues. So I think that is the nature of the beast, that there is high mortality. And as an investor, then it is our job to make sure that in our portfolio we have as low mortality as possible. So, looking at the current situation, I think it is expected that a lot of easy money came in. Lot of we also saw suddenly on platforms, 6,000, 12,000 investors registered, and very loose with their wallets when these startups start raising money. But all those investors have now vanished. They have vacated the market because the money that they have invested, now they're realizing that it's locked in for a long period of time and there's no guarantee of getting it. So I think that speculative element, that easy money element is out of the market, which is good in a way, because when we have a fund, when we are trying to do things in a more structured manner, you don't really want to compete with people who have low quality standards, because then you miss out on good deals. So I would say that this is quite a positive environment right now, where savvy investors who have the capital can make use of this environment to invest in good quality companies at very reasonable valuations, after a long time.
Yeah, so I think the startup also will have to eventually understand that the liquidity is not, I mean, the availability of funds is very important aspect,
Yes.
and they have to learn to utilize these funds even more efficiently, and effectively.
Yes.
Otherwise, the whole ecosystem gets affected because of some of the malpractices done by some mid-sized founders, and this is my experience.
Of course.
We also invest in a couple of them, so. Like London Club is one. I mean, just disclaimer here, we are just discussing one idea. So
Yeah.
we saw that there's a good amount of growth there. So that's how it is. Anyway, so you said that it's going to be for 10 years, and one has to really look at a long-term wealth creation, and power of compounding also going to play important role in the long run.
Yes.
And you see you're able to ride through the growth journey of these startup ideas, which eventually going to become very, very large.
Yes.
So that's how it is. So with that, we'll open the forum for Q&A. If any of the investor has any question, they can feel free to ask. I can see Darshan ji and Manav ji. Please feel free to ask. In the meantime, so my last question to you, Abhay ji. So you said that you're sure that which are the sectors that you're not going to invest, but what's your reading? Where do you see a lot of money is getting made in this startup space?
I think so. I'll compare this to what my experience was when 2000 to 2004. I used to live in Hong Kong. I was working for JP Morgan Private Equity Fund, and I used to travel to China a lot that time to because JP Morgan was investing in China, and a lot of other foreign funds, US funds, had set up base in Hong Kong to invest in China, because China was frankly where India is right now. In terms of economic activity, in terms of per capita growth, GDP levels. demographics, most importantly. And what I saw in China that time in terms of a startup ecosystem coming together finally is what I can see happening in India now. So we are behind China by 18 years or thereabouts, but that is, that is really what it is, where now for Indian startup founders, there is capital available, which was not the case even 5 years back. There are funds, a lot of funds who are willing to take the bet on founders, new ideas, new businesses. And that was the time in China that companies like Tencent, Baidu, ByteDance, Alibaba got created. That was a period. So I think in India for next 5 to 10 years, we have a golden opportunity for the first time to back these companies as investors. If you look at it, earlier these opportunities were not available to individual investors, even though you may be an ultra HNI family office, but nobody was willing to take money in an angel round or in a startup round. People would go directly to a VC or a private equity fund, or do a Series A or Series B. So this whole opportunity space that has opened up now, I think it is a tremendous opportunity for people to invest in good quality startups over 5 to 10 years, and then see them grow and see the tremendous wealth that these opportunities create for them. And then I don't think we need to really look at companies that are or particular segments that will do better than others, because I think opportunity is there in everywhere. Even there is so much of inefficiencies across the industries, across supply chains, distribution chains, in processes of banks, new products that can be launched, because the whole with D2C, with internet, it is very easy for people to start selling directly to consumers, through Amazon.com, through Flipkart.com, through their own websites, getting payments, digital payments, collecting money through Razorpay or Paytm has become very easy. So really, it has given tremendous input to any kind of entrepreneurial activity. You can, if you have a good idea, you can start something, show success, and then seek growth capital. So I would say it's a very wide opportunity space right now. It's left to the investors then to choose very carefully what they want to invest in.
I can see a couple of questions raised by some of our investors. So with your permission, I'm taking it by one. So first is there any exit possibility before 4 years? Then the second question is how does the taxation work on the capital gain?
Yeah. So I think exit opportunities, whenever we get, we will definitely make use of them. But the reality is that it is difficult. I would very, very candidly say that many a times as angel investors, the exit is not in our hand. We can't force an exit. The best exit is when somebody wants to buy your shares and makes you an offer, and then you can consider that offer. But typically, and in 4 years, whether we get an offer, it is possible. It has happened. Like I'll give you an example. Khatabook is a company that I invested in January 2019, and I've already, in 3.5 years, I've already got 4 times offers to exit. From every round that was done by a large investor, they offered to buy out the small early stage investors. So it is possible. However, there is no guarantee. It really depends on situation to situation. So I won't guarantee that. On the the second question was
on capital gains.
Capital gains is something that it's very simple. So the angel fund, since it is a category 1 AIF, it is a pass-through entity. So the fund itself doesn't pay any tax. However, on gains that it passes back to investors, it deducts a 10% capital gains, 10% TDS, and then after that the investors pay 20% tax on long-term capital gains after indexation. So it's a pretty simple, straightforward, capital gains taxation for investors.
Yeah. So the long term is 3 years or 1 year? In this case, it is 3 years because it
Yeah.
comes under the debt category. So therefore, this is for 3 years. Yeah. Next
Yeah, I
question
think,
is,
yes, please go ahead.
looking at the current IPO-based companies in recent times, what do you think about future? For example, Zomato, Paytm falling from the listed valuation. Yeah, that's a good question.
Yeah.
Thank you for asking. So, he's saying that Abhijit, that we saw the kind of hype it was created for company like Paytm, that you hold a good chunk when it is not listed, and then after that you see valuation going down. So, your take on that, please.
Yeah, so I have been very, very candid on this since the beginning, since these companies have listed, because that these companies should not have listed. Any company that is still making losses, that is still dependent on investors' capital, there is no clear path to profitability. If you look at Paytm, still not able to tell clearly what is its profit path to profitability. When will it turn profitable? Or look at Zomato. They announced that they will turn profitable next year, third quarter, and then they did the acquisition of Blinkit, which makes their profitability again uncertain. Or you look at car trade, or you look at some of the other companies that have listed. Nika is an exception. It has skeletal profitability, but still burning cash. So I think these companies should not have listed. These companies should have stayed private till they become profitable, or close to profitable at least. I think they all listed at a time when there was an IPO frenzy driven by global events. Globally the FANG stocks were doing well, and then there were companies in China and US that had listed and done very well. So I think the investment bankers, funds that wanted to exit, and of course the founders themselves got together and got excited and said, let's list. So I think fundamentally it has been a mistake to list these companies, and I think it is for the regulators to go back and introspect and say, why did we allow these guys to list? Because for a long time there were very strong requirement of profitability, dividend track record, revenue growth for a company to be able to access capital markets, to be able to take money from retail investors. So now what is happening is that there is a valuation reset where people, the speculative capital, as it exits the market, these companies are finding it difficult to now sell the story. There is no story, frankly. So I think these companies have good long-term prospects, and I'm sure Zomato and Paytm kind of companies with their presence will do well, but it may be a very long period, before investors see some returns, see some money back. So yeah, that is what I would say. So I don't see any more such companies listing in a hurry. Delivery was the last one to list. I don't see any companies like these finding any takers in capital markets for the next 1 year at least. So I think people should just ignore what happened. And other thing I would say is that, look, these companies have lost, public investors' money, but the startup investors who came in 12 years ago are still up anywhere from 400 to 800 times their capital. So the selling that you see now, post 1 year lock-in getting over, is by early stage investors who are still up 400 to 800 times. So those are the guys who have made money, and the public market investors unfortunately have lost money.
That's another question coming from Tanmay. This is an interesting question. With unicorns in India increasing day by day, are the valuations fair looking at the loss-making startups like Thread, Byju's, and etc.? So yeah, so how do you take this question?
No, that's a great question. I think we were also surprised looking at some of these valuations of companies becoming unicorns. They do have a business, as in, they have found a niche. They are growing rapidly. They have taken leadership space, created very good brands, in many of these spaces. However, I think a lot of the unicorn valuations will come into question now. Already we are seeing down rounds happening. Already we have seen companies that, for instance, raised money at unicorn valuation, now being forced to take money at 40% lower, 30% lower, 50% lower. So that is going to happen. The good thing is that at lower valuation, at least they are getting money. And now people are realizing that the easy capital has gone out. So now it is time to go back to the drawing board, build the business, create value, and let the business growth drive shareholder value rather than the multiples in capital markets driving value. So that is it's a process of adjustment that is going on. I think a lot of adjustment has already taken place, and some of it will take place over the next 6 months to 12 months.
Question is from Chaudia ji, Mr. Chaudia. So he's asking Snapdeal, Oyo, Oyo and Ola. People have made good money, but looking at their balance sheet, is it okay to invest in unlisted segment? Yeah, so basically the question is that some of the startups like Ola and Oyo, people have really created good amount of wealth, those who came in early stage.
Yes.
And do you think these valuations are sustainable?
No, I think even if I look at the unlisted market, there are a lot of these shares of these companies that are pre-IPO kind of companies that are trading in the unlisted market, and these shares have also seen a correction along with the big ones also. I mean, why look at these companies that have big balance sheet? In the unlisted space, you have companies like HDB Financial Services, which is HDFC Bank's NBFC, seen its price become half of what it was 1 year ago. And I think all that is happening because of the severe correction of valuations across the board. I mean, we saw Bajaj Finance also fall from almost 10,000 rupees to 5,000 rupees. Now, I personally would not advise anybody to buy unlisted shares of these companies expecting that an IPO will take place, because right now the sentiment is completely against listing of companies that are still loss making. So I really don't see how Snapdeal, Oyo, or any of these internet-based companies will be able to do an IPO for this year at least, and give an exit to their investors. So I would suggest that investors be very cautious before buying unlisted shares of these companies expecting an IPO in next 12 months.
Moreover, I would suggest that as an investor, you should be looking at the fund level and not at the individual companies, because the reason is actually because at the fund level, the way the fund is constructed, the way portfolio is constructed, there are different companies which come in, and it's well diversified. And generally, my observation in startup, 90% idea gets failed eventually. What you feel today is looking very exciting. Maybe 2 years down the line, the story gets over. So therefore, this is very, very important that neither you have an access to their balance sheet, nor you are speaking with founder, nor you have understanding and talking to their vendors, and nor you have that kind of time to really get into that kind of research. So therefore, you should be giving mandate to portfolio managers like Piper Serica, where they have a complete team. So now I can see there are 3-4 of team members who have joined, and their full-time job is to do complete research, talk to their competitors, talk to their vendors, and understand whether the founder is making the payment on time or not. Doing all sort of due diligence in terms of looking at whether the founder is filing the income tax on time or not. Well, filing the income tax on time is not a big issue, but that really indicates that how disciplined the founder may be, that reading of the founder and all that. So these are very, very important aspects. So I would suggest all my investors to please, stay away from that. While I understand maybe in the secondary market, you wish to invest, you may do so. But as far as this space is concerned, I think I would strongly recommend that you should be giving mandate to portfolio managers who are running this game even more professionally. So with that, I would like to conclude the session here. Thank you so much, Abhay, for taking the time out from your busy schedule and joining in today. It was great reading your mind, and you got a lot of learnings and a lot of insights about what's happening in the startup space.
No, Vikas, thank you so much, for giving me the time, and really it's wonderful what you are doing in terms of educating your investors about different opportunities. And it is my pleasure to be here and talk to your investors and engage with them. So thank you very much. Look forward to doing this again sometime soon.
Thank you everyone. Bye.